So we're very happy to have Sam Hartzmark from Boston College present price-agnostic demand. This paper will be discussed by Marianne Andries from USC.
Well, thank you so much. Thank you for the invite to come and present this paper. It's joined with Abby Sussman, who's in the marketing group at Booth. This is a new paper, which is always fun to present. And it's a paper that started life talking about multipliers. So Zabe and Ralph have a paper. I've got a paper showing that for every dollar in the market, the price moves by a lot more than that. And that's really surprising, kind of based on any of our standard theories. And so thinking about potential mechanisms behind that. And one of the things that we kind of thought could be important is thinking about the current level of the market price. And is it the case that people actually have a lot of conviction about it, are willing to trade based on it? And we're going to argue that no, people seem to be very agnostic about what that market price should actually be. So that's where we're going. But before we get there, let's start with kind of what does asset pricing say? So I learned asset pricing from Cochrane. Here's the first page of Cochrane's preface where he says asset pricing theory all stems from one simple concept derived in the first page of the first chapter of this book: price equals expected discounted payoff. Okay, so what does that mean? Clearly, uncertain outcomes are kind of the key of all asset pricing. And so there's certain things we care about that we don't understand in the future. We form beliefs about those uncertain outcomes, cash flow fundamentals, depending on your model, whatever discount rate you might care about. And then based on our beliefs about those fundamentals, we have a strong belief about what the market price today should be. The future is very uncertain, but the present is very well understood. And so what our models say is that people have a lot of conviction about the market. So if you went and formed those beliefs about, cash flow, discount rate, whatever, and if you didn't see the market price, you would have a very strong belief about what it should be. And if the market price was very different from that belief, that would really have a big influence on how you viewed the world. It's just like a simple example to kind of think about what we're meaning. So let's say the S&P 500 was currently trading at 4,000 today, and that's consistent with whatever your kind of favorite asset pricing model is. And let's assume that an investor from that model, based on current fundamentals, thought that 1 year in the future, it would be at 4,200, a 5% return. So what would happen if this investor rolled out of bed and the market wasn't at 4,000, it was at 3,000, but all the fundamentals were the same? Well, our models say that they would view the S&P is expected to be at 4,200 at the end of the year. They'd expect a 40% return. This would, of course, very much change their behavior, which is why in our model, you would never see an outcome like that. So that's what our models tend to say. But what we're going to ask in this paper, is this really the case? Do investors have a lot of conviction about what the current level of the stock market should be? Of course, it's very straightforward to use accounting identities and derive that price equals expected discounted cash flows. That doesn't mean that's how investors necessarily perceive it, or that it really is explaining market dynamics. So for a very different opinion, here's Fisher Black's AFA presidential address, where he says, look, we might define an efficient market is one in which price is within a factor of 2 of value. Basically, price could be double, price could be half. It'd all be all good with market efficiency. By this definition, I think almost all markets are efficient almost all of the time. Now, I'd say in more modern parlance, this is almost trolling, right? This is a very different definition of market efficiency than what was meant. This is saying, I don't really have a strong conviction about the price. There is a wide range of prices that I would accept as reasonable and wouldn't really change my behavior. So we're going to call this type of beliefs a price-agnostic investor, right? So if today you don't have much conviction about what the market price should be based on fundamentals, well, 1 year from now, you also won't think you'll have much conviction based on fundamentals. So it wouldn't really make sense to kind of go from those fundamentals, create beliefs about cash flows, discount rates, and predict the market kind of in that next period. In this case, you would maybe, have time varying return expectations, but those expectations wouldn't really be driven based on kind of beliefs about the level of the current price. You're largely agnostic as to that price level. One thing I want to be really upfront about, and to make sure this is clear, this is not a full asset pricing model we're building in this paper. We think this is one channel that isn't really emphasized or explored, but clearly there are other things that are important. And one of the things we think is nice is there's a clean testable prediction between kind of our standard asset pricing models and a price-agnostic investor, which is, well, do investors actually have a strong opinion about what the market price today should be if they don't actually see it? So returning to our example, let's say assume the S&P was at 4,000 today. You have a price-agnostic investor who thinks there'll be a 5% return, 4,200 in a year. Well, what would happen to this investor if they rolled out of bed, all the fundamentals were the same? Well, they'd also predict a 5% return. Let's say the market would be at about 3,150 a year later. Now, this is not the newest of ideas. This is from an AFA address in the 80s. But you can see that, at the time he said, first off, I recognize that most researchers will regard many of my conclusions as wrong, untestable, or unsupported by the evidence. But unfortunately, he hadn't thought of any way to go about testing between these beliefs and those that were more standard. So what's the ideal experiment? Well, if you could take investors and just kind of randomize the market different from whatever it was. Some saw a price that was higher than it actually was. Some saw a price that was lower, while all the other fundamentals were the same. Would investors notice? Would they view this as a fundamentally different situation? So our asset pricing models say absolutely. And if you're a price agnostic investor, not so much. What actually is true in practice? Sadly, the S&P did not allow us to commit fraud and just kind of show people the wrong number every day. So we're going to try to, in an experimental setting, capture that base intuition. What we did is we chose actual dates where there was actual economic fundamentals and an actual market price, and we showed people the economic fundamentals from those days. Then we showed people market prices, but we manipulated that market prices. We did so for each day. We chose a number between 5 and 50. Some people saw the market increase by that amount. Some saw it decreased by the amount, some saw the actual. And then we just went and asked people, well, what did we actually manipulate this market price by? And we did so in a bunch of different ways. We ran this on a few different samples. One was Booth MBA students. One, unfortunately, they need to remain anonymous, but it's one of the world's largest asset managers. They're deep-pocketed investors who run institutional money. If I could tell you the name, you would know who it was, and I think you'd agree they're kind of who you'd want us to be asking. And then we ran this on a large sample on Prolific, which is similar to Amazon Mechanical Turk, kind of easy to access internet panel. And this is what we found. So what I've got here on the x-axis is the induced level of mispricing. So all the way to the left there, you saw people who saw the market price a bit over 40% lower than what it actually was. All the way to the right, the market was about 40% higher than it actually was. The y-axis is the perceived mispricing. What people said they thought the market was mispriced by on that day. And then the gray line there is the 45-degree line, which is the correct answer. And I think what you can see is people missed most of the mispricing. Not all. If you squint, it's kind of a regression line here would give you about 0.1. So it's not that people weren't paying attention, that they missed everything, but the vast majority they weren't able to identify. They weren't particularly good at this task. So that's going to be kind of the main result of the paper, that kind of no matter who we ask and no matter how we ask it, investors seem to generally lack conviction on what the level of the market today should be if they don't actually observe it. This is going to be similar across subject pools. Our asset manager sample is a bit better than the others. We're going to do this like what I just showed you in terms of what was the amount. We have one version where we just say, did we move it up or down? People are better than chance, but not a ton better. It's kind of weird to ask about induced mispricing. So we have a version where we ask instead about return expectations to what the market price actually was a year later. We don't find very strong results there. For our asset manager sample, after we ran this test, we just went and directly asked them. We said, look, is there a set of information that I could give you where you could get within 10% of the market price if you didn't see it? And our asset manager sample largely said no. About 70% said it wasn't possible. We asked, was there information that we didn't give you that you'd want to see? And again, most of the people who said it was possible said it wasn't. Last bit of the paper is we're going to turn just kind of real world data, right? There's kind of forecasts of returns. There's investment advice that's out there. And if you think about what's out there, it seems largely price agnostic. So most say return expectations done by professionals, basically regression models of historic returns on present returns. This isn't what our models say we should be doing. It does give you some predictability. If you think about most investing advice, it says, a kind of classic academic thing is just buy the market. It doesn't make sense to try to beat it. Of course, initially that was founded more motivated based on constant discount rates, efficient markets. This is coming there because there's extreme uncertainty about what that market price is. So overall, we think this is an important channel, one that we haven't really thought too much about or kind of focused on in our models. And we think that kind of moving forward, that'd be a good thing to do. So just in terms of kind of implications, I'd say the most obvious one is just kind of the concept of market efficiency limits to arbitrage. If people are incredibly uncertain as to what the level of the stock market should be, they're obviously not going to be willing to trade heavily against it. And that would suggest that prices are just going to broadly be much less linked to fundamentals than our standard theory suggests. There are, economic mechanisms that, of course, are going to eventually push prices back to fundamentals. But I think this speaks to the fact that these probably are occurring not at the horizons we tend to think of, maybe a month or a year, but over much longer horizons. And you think about things like real-world forecasts of returns, they do report annual numbers, but they're really making very long-term forecasts. Of course, I think this is one explanation for excess volatility. The standard thing we tend to focus on is, look, prices are moving way more than cash flows. This is because there is ex-ante understood discount rate variation. And I think this speaks to another potential mechanism of, prices are moving around because people are very unsure about what that right level is. And of course, why we started talking about this is, why is it that trade has such a big impact on prices? And well, if no one's willing to kind of strongly counteract the price impact of flows, I think this is one potential mechanism that can help to understand that as well, too. Okay, so that's where we're going. This is the experiment itself. So what we did is we just looked at daily data from 1971 to 2021, and then we randomly picked days over those 50 years. We gave the actual fundamental on those days. We tried to focus on kind of the standard variables that tend to receive attention in the real world that are kind of suggested by our models. We want to be very upfront. We're showing people like 6 numbers. There's a lot more information that's out there in the world. There is private information. There is nuance. All sorts of things are important. We are going to be missing that. Now, we're also going to be shifting prices by like 40%, so hopefully this would be enough to at least give a good idea. We're going to show kind of information on earnings, the risk-free rate, inflation, prior GDP growth, expected GDP growth, and volatility. Again, this is kind of the first draft. We'll run a robustness where we put in anything else you want to see. Let us know what else you want to see, and we will throw it in there. And the next draft, you'll get to see if it works. A big part of kind of figuring out the experiment, I'm not going to talk a ton about the experimental design, was how to do this in a way where it was plausible that people really got what was going on. So we gave very intuitive definitions. We gave people tables of historical averages and ranges for each of the variables. We asked comprehension checks to make sure they understood the relevant economic concepts. And that's kind of how we set things up. This is kind of the reference table we provided. So you can see we've got kind of a variable, we've got the definitions, we've got the historical average in that period, and we've got the historical range. And then people had access to that, and the instructions were pretty straightforward. He said the value of the S&P 500 and the price used in the price to earnings ratio will be shifted by a percentage, which could be positive or negative. We gave an example of kind of a price being shifted, and then at the bottom we said, your task will be to determine to what extent the current market price displayed is higher, lower, or the same as you think it was on the relevant date. And then people online saw a scenario like this of a specific set of days. And this was over a page like this where it said, looking at kind of this chart above where you saw those numbers, What do you think we shifted things by? And you had a slider, you could leave it as exactly the same, move it to the right for higher than the level, move it to the left for lower than the level. And then underneath that, we said, well, what do you think the S&P 500 actually was 12 months later? So this should give us kind of a return expectation, both of expected returns and of misprice. So the average of the random draws was about 20% for the X. So there was 10 days we chose to focus on. I'm chosen at random. Each day had a specific X assigned to it, where on that day, you saw a third of the numbers increased by, a third of the participants saw numbers increased by X, a third saw things decreased by X, and a third saw the actual level of the S&P. This is showing you kind of what the correct response would be. And also, I should say, everything was randomized as you would expect in terms of ordering and, who saw what and things like that. So that's kind of, what was in the data. And here were the responses. So just aggregating everything together, you can see that on average, the high correct answer was about 20, and the answer given was about 17.5 below it. The low correct answer was about -20, and the actual answer was about 18.5 below it. Now, it wasn't all bad. You do see a monotonic increase. People were kind of able to respond to some of this, but they missed the vast majority. Here's each of our subsamples, and you can see, again, the advisor does do a little bit better than the others. The booth MBAs do a little bit worse than the others. But all in all, each of these samples is pretty consistent, and each of them do miss kind of the majority of mispricing going on. This is the figure I started with some actual in the middle. So you can see, kind of looking further in terms of the nuance, it doesn't seem like it's something like, I don't know, if you only see the market mispriced by 10%, you get it wrong, but you really get the tails or something like that. It's pretty consistent. The paper does regressions. I'm just going to show you pictures. But if you run a regression, you get a coefficient of like 0.1, statistically greater than 0, but also statistically very different from 1. Now, each date had fundamentals. So is this being driven? Maybe we didn't randomize enough. There was some specific correlation with fundamentals. So we can put in a date fixed effect, and the answer seems to be no. And you can see a lot of the variation seem to be driven by variation in those economic fundamentals. Now, this does lead to a question. I've kind of shown you that there's not a strong result to what's going on. Were people just confused, right? This is kind of a weird task. Maybe people just weren't responding meaningfully to this prompt at all. So the first piece of evidence we can look at is now I've graphed things not based on the actual level of mispricing, but basically by date, by the specific mispricing on that date. And first thing to note is kind of, it should go green highest and orange lowest. Only 4 out of the 10 dates is that ordering right. The spread's also far too narrow. But there's a lot of variation by date, right? This isn't random. People are kind of clustering on this given date based on the fundamentals. And so, for example, if I redo this based on like price to earnings ratio, there actually is a decent amount of predictability. So people were paying attention. They just weren't able to perceive what I was manipulating the price by. And you can look at the other variables as well, too. And people do tend to respond to the variables. They just don't know what the manipulation was. They can't back that out. Now, another thing we could do is we could say, look, it's weird to ask about level of mispricing. In practice, that never happens in the real world. Instead, we can ask people to predict future returns. This is more natural, kind of more common. So we said, what do you think the returns will be from the price I showed you to the actual price 12 months from now? So that should capture both the correction of the mispricing and return expectations. And if we do that, people don't do much better. So here, it should be a negative correlation. You should get something close to -1. We're finding coefficients of about -0.04 here. Last thing we did for our asset manager samples, we kind of like our experiment, but it's really a revealed preference approach. But we could just ask people, do you think you can do this? Is there a set of data where this task would be feasible? And this is a very different method. And we think it's kind of nice to show things using a very different kind of mode of doing it. So basically what we did is we asked the sample, do you believe it's possible for investors to use information on fundamentals to determine the market price within 10% of the actual value? They said yes. We said, well, we just showed you some information. Is that what you would want to see? And if they said no, we said, well, what else would you like to see? So basically, most of them said they didn't think this was possible. So about 70% of our respondents said this task is crazy. There's not a set of data that would get me within 10%. That's kind of inconsistent with our models, but very consistent with a kind of world where people are largely price agnostic. If it was possible, was the information sufficient? Most said yes. So experimentally, it seems like people aren't able to kind of identify these large deviation in prices. They don't seem to think that there's a set of data that would allow them to do so. And so let's now turn to kind of some real world examples and see what happens. So first off, if most people are pretty agnostic about their ability to kind of understand the level of the market, identify the level of the market, it wouldn't be that surprising if there's not a ton of attention given to that task. And if you think about, I don't know, the Wall Street Journal, the Bloomberg Terminal, whatever it is, there's a lot of focus on the cross-section, much less data and much less focus on kind of aggregate level mispricing. This is similar to Alex has a nice recent paper looking at how analysts make forecasts based on future price targets. The first thing they do is they basically accept the current price to earnings ratio kind of is given and then multiply things out. And then just in general, you think about how most money is allocated, where there really is conviction. Most strategies do tend to be more in the cross section and less on kind of trading on kind of market level mispricing. In terms of investment advice, a lot of advice seems to be largely price agnostic. So, classic academic advice, Samuelson, famously, or at least supposedly said, market timing is a sin. Kind of a Bogle type view, don't do something, just stand there. And this really makes sense from a price agnostic standpoint. I don't think I really understand the level of the markets or that I can predict returns. Therefore, just kind of hold things. Again, this, historically was motivated due to like 1970s market efficiency, at least in the academic world. But in a world where with, big variation in predictable discount rates, it makes less sense, but it kind of comes full circle in this framework. Now, with that said, of course, people do try to actually predict returns. And our asset pricing models say what you should be doing, right? You should try to go and figure out cash flow fundamentals, right? Maybe fundamentals are high because AI has shifted duration, something like that. Discount rate information, that's going to shift expected returns. If you believe in mispricing, institutions being stressed, whatever it is, you'd really want to understand these fundamentals, understand what the level of the market is, think about implications for future returns. Now, if you're a price agnostic investor, you may well think there's time variation in returns and you can predict them, but it probably isn't going to really be driven by a conviction in the current level of the market price. Okay, so how are these forecasts actually made? So I'm just going to walk through a few examples. Here's a recent one from Vanguard. They were making in February 2024. And so the main thing in this Vanguard forecast is basically a quant forecast. So they do have a model, but realistically, it's kind of a fancy regression. And what was driving everything in this model is that CAPE was at the 99th percentile historically. According to Vanguard, that meant their model was that the market was 30% overvalued relative to the level that kind of their market was suggested. Okay, so the market's massively overvalued. What do they say to do? Well, they say to not do anything based on this information. How confident are they in their models? Well, they say a lot of things like, look, while the evaluations are high, that doesn't mean they can't go higher. What do they make of the extreme mispricing? Well, they shifted their return expectations down by about 1%. They'd shifted it up 2% the year before, so very in line with recent years. So this is consistent with there being some weight on fundamentals, some variation in returns, but being pretty agnostic, even in a world where they think their model says the market is way overvalued. Another recent example, Goldman had a forecast that came out very low relative to everybody else. So they said the market would have 3% returns over the next 10 years. Everybody else is kind of 7 to 9% in this era. Okay, so the conclusion the Wall Street Journal said is buy stocks anyways because the next year looks great. So again, not a massive amount of conviction behind this. And if you dig into the Goldman, I'll go through skip through the details. Basically, Goldman threw in a concentration variable and they give you their model. It's just a regression. And this is kind of the sketchiest in terms of statistical significance. So why did they do this? Well, if you dig into their appendix, because their 2012 model had a big miss, and it was embarrassing. And they chucked this model in ex post to fix the prior 10 years. So, again, this is predictability. It's an improvement. This doesn't seem to be a massive amount of conviction. Someone like with Asmus at AQR says, look, there's some predictability. You should do a bit, but there's not a ton of conviction there. Anyways, the paper has a few other discussions about some implications. I'd say one thing I didn't have time to do with is this is broadly consistent with the JDN literature, right? So if I were to just describe the last 40 years of psychology and judgment decision-making, humans are really bad at levels. And this is consistent with that, and we think is consistent with a number of stylized facts, and hopefully useful. So thank you guys very much for listening to me, and thanks.
Okay. Marianne Andries from USC will now discuss the paper.
Thank you so much for inviting me to discuss this paper. I had a lot of fun reading it. I expected Sam to do a great job presenting what he's doing, so my discussion is barely going to recap what the results are. And I'm just going to, also because it's a new project, from what I understand, I'll suggest areas where maybe the authors could extend a little. And so let me get started. And Sam started with the same quote. And so, yes, we do asset pricing. The idea is that we know what prices are. They're the expected discounted payoff. I also learned asset pricing from John. And so, yes, this is what we learn. Now, under the efficient market hypothesis, with some Grossman-Stiglitz throwing in there, then deviation from that equilibrium price will be exploited. Again, there's with the market for information, you can close the paradox of Grossman-Stiglitz so that some investors will get informed and they will be able to benefit from it and close the loop and get to these prices. Now, what I think is really fundamental about this paper is that they're raising a new paradox compared to the previous one. The previous one was, well, if information is useless, why would people look for information? And if they don't get information, how do they get to the correct price? And now what the paper is raising is, well, let's assume information is there, but will they even be able to use that information to get to the correct price? So it's the next level, more behavioral type question, which is, are they even capable of getting to that level given information? There's no other constraint. And this is really what they're asking. So can individuals, and they're trying several types of individuals, even identify mispricing when they're given information? And I think because the answer is mostly no, from what Sam showed you, they don't really spend that much time trying to look at the next question, which is really the fundamental one, which is, even if they do identify mispricing, will they try and exploit it to get us back to efficient market hypothesis? So I do think it's a really important question. And let's just go over very quickly, but again, Sam did a great job. So this is the main picture. They don't really identify mispricing, and the mispricing can be really big, like from plus 50% to minus 50%. And well, as you can see, there's there's no capacity to identify it. And I want to, so this is a little less put forward in the paper, but the next result I think is also interesting, is that even when they think they identified some mispricing, they don't want to exploit it. So if they were convinced in their own mispricing, which they don't identify well, but let's say they identify there's a 2 percentage points mispricing, they could just think, okay, well, then I will have returns reflect that, and you should see a exact -1, essentially, like mispricing will get into returns, but they don't do that. They use it a little bit, but much less than, even if they just identify some very small amount of mispricing, they're not even trying to use it. Okay, so the author's interpretation, and Sam did a great job going over that, is, well, it's really hard to understand levels. And there's a lot of literature showing that we're good at looking at relative things, but not absolute things. And it's just one more example of irrationality. And well, even professionals do not understand market values, and they do not understand exploitable returns predictability. If there's mispricing, there should be predictability. They should be able to exploit it. They're not capable of doing that. And therefore, that could explain some well-known stylized fact that we know in the market. Okay, so that I'm actually quite sympathetic to this interpretation. I'm a behavioral finance person myself, so I'm perfectly happy with all of these. I just think that in order to get to that conclusion, we need to rule out, maybe that's unfair, but I actually want to rule out other more rational explanation. So possibly, well, I thought there would be some quotes there, but let me go over it one by one. First thing is that understanding absolute value is not just hard. That's just not what we do. Our models are not absolute value models. And what the information that is given to the subject are returns, growth. These are not absolute levels. So I think the authors should focus on the price to earning ratios rather than the outright S&P 500 level. Since we're quoting John, I remember him saying, asset returning sounds bad. That's why we call it asset pricing, but we really only have models for returns. So I think this is really, that's a minor point because the authors do look at mispricing of price earning ratios, but that's what I want to focus on. And I will almost entirely ignore the results on the outright level of the S&P 500 in this discussion. Now, the other option is it's great. Everyone understands that markets are overall efficient. So it's very hard. They all read the Wall Street Journal. They all know it's really, really hard to do market timing, that in general, actually, even professionals lose money when they try to do that. So they've fully integrated it. It's great. We've done a great job. And so they don't even try to spot mispricing. So then when you suddenly give them things that they are so unused to do it, they don't do it, right? And, well, that's basically the last point is this one, is that market timing strategies do not work really well in the data. You do see these headlines saying, oh, people have been trying to do market timing. So we do have models of time varying discount for risk, but they tend to be at a frequency that is not like, this is not how people think about dynamic strategies. They want to do market timing 1 week to the next or 1 month to the next. And that actually, as far as I know, still doesn't work really well in the data, right? So that's another interpretation. And so I was like, okay, but we still have this paradox that if people do understand that there's no point trying to understand mispricing in index, why is it still reflecting some sort of efficient market hypothesis? Why is it that the price still seems to be correct in that we can't exploit, even when we're trying hard to exploit market timing, we can't do it. So we get to a new paradox, which is people don't try to find mispricing, but it's not there. Why is it not there? So I tried to understand it a little more. And so I was like, okay, let's go back to the experiment. And Sam was smart because he didn't show these things at the same time. But if you put them next to each other, I was like, okay, wait a second. That's what the subjects see. And then that's their question. And can I do it? And I actually, if I had a longer discussion, I thought about giving a QR code to everyone here so that you could be the new subjects. And I think it's really hard. That was my first point, was that's hard. And I was like, okay, wait, what would I say? Like, I'm supposed to be, I'm supposed to know some things. So I was like, that looks hard. But wait, I know models, I know data, what can I use? And so I was like, okay, well, I do know consumption-based asset pricing models. I've done my John Cochrane's class. And I know that, well, in a lot of them, we don't have state variables. But when you do have state variables running around, price earning ratios will catch some of that. And what are the state variables? Well, in the data they give, let me just show it again. You do have, well, the level of the S&P I'm going to ignore for what I said before, but I have my price earning ratio. That's the one I want to see if it's correct or not. And I have interest rate inflation. So that gives me real risk-free rate somehow. And then I have expected growth and past growth. Okay, so these are the data I can work with. Among these, well, I identify expected consumption growth as one state variable that I can use from long-run risk models, or past consumption growth that I can use in a habit model. So these I know roughly what they should do to my price earning ratio. And then I also have a risk-free rate, or I can figure out the risk-free rate. And if there are other state variables then related to consumption growth, I could try to extract it from my risk-free rate. So if I have time-varying volatility or time-varying disaster risk, that should enter my risk-free rate, which should then be in my price-earning ratio. So I have some things to do. Let me go back to the data. I'm going to try to identify mispricing from that. And so, I'm there and I'm like, okay, wait, let me start with the simplest one, which is the one I know straight away, long run risk. Economic growth forecast is 2.7. The average on the left-hand side is 3. So my price-earning ratio should be just slightly below my average. And it's 21. The average is 24. Yeah, that seems kind of okay. So I'm like, okay, I probably, from that, I'm thinking not too much mispricing. Of course, I don't know because I don't know how persistent, like things are, but like that seems kind of okay in terms of at least directional. But then I'm like, okay, how is my risk-free rate? So if I look at the risk-free rate, I have interest rates minus inflation. That's like, okay, 4.8. That's way higher than usual. And I know that the risk-free rate is high if actually other state variables are super well behaved. So volatility is very low, or the probability of a rare disaster really low. So then my price-earning ratio should be higher. So now I'm like, wait, is it too low? Is it mispriced that way? Okay, I'm going to cut it short because I don't have tons of time. But my conclusion is that it's still hard. I'm still kind of lost. I've tried my best with models, and I still find it really hard. And again, I think if we had more time, it would be fun to know how, like, everyone would answer this. But I was like, I really don't know. I wouldn't know how to answer. Okay, but I'm not just a subject. That's me, by the way. I'm subject to 90. I'm trying that experiment, but I have access to the experimenters. And so I asked Sam, okay, can you give me all the data that you're using for these things? And so I'm going to try to see what the data tells me, right? So now that I have data, okay, all these things matter, but maybe I can do better. So I'm going to regress my price-earning ratio, the actual price-earning ratio in the data. So not the mispriced one, the actual one. Which might be mispriced, but I'm going to assume no, because markets are doing whatever, like this is the actual price. And I'm going to see how much the variables that were given, so expected consumption growth, past consumption growth, inflation, and the 10-year bond, how much do they help to get to the price-earning ratio? And they do help. I mean, our models are not completely useless. We do know that they help. These are good state variables to understand what the price-earning ratio should be. But the problem is that even with this data, on average, my mispricing is 20%. And so, I mean, even with the best intention, if I'm using my regression and my price-earning ratio, the price-earning ratio that I see in the experiment is 20% away, I can't say that it's mispriced. It's just that's the average distance to my regression. So the problem is that, so it's better than with no data. Like otherwise the price-earning ratio moves around more, but it's still not enough to be able to really spot mispricing because that's kind of standard to be 20% away from whatever the regression is doing. Now, I'm going to be crazy and do something that would get me kicked out of first-year econometrics. I'm like, okay, fine. They also want to do the S&P 500, so let's see if I can. I know I'm not allowed to do some regression on something that's definitely not stationary, but I'm going to try. And maybe in this particular case, you could predict the S&P 500, but well, I mean, this is crazy. It's even crazier. And here, the average mispricing from this regression. And actually, we're lucky that there's some trend here that is actually coming from the 10-year bond. So we catch some of the trend. But we still have a normal mispricing of around almost 200%. Okay, so I'm like, okay, with the best intention, I wouldn't be able to spot mispricing. But of course, doesn't mean no one can. But I think that's the part where this is a really, really hard problem, even with models, even with data. Okay, so my conclusion on that is that it's just not easy to interpret. I do think it's a really, really important question, but it's not easy to interpret. And so I'm going to go back to the paradox itself. The paradox is it's very hard to do, but somehow it seems to happen that prices do reflect some sort of fundamental value because people who are trying hard to exploit mispricing are not getting anywhere. Or I know you can try a little, but again, I think overall market timing doesn't seem to be the winning strategy that firms are trying to do. And Sam gave a lot of examples that actually, no, they're not trying to do any market timing because they know how hard it is. And so, well, that's what I just said. All right, so how do we solve this puzzle? This is the new version 2025 of the Grossman-Stiglitz. Now we're not about information. We're really, how do people form these expectations? And here, this is where I just want to give some suggestions for where we could go. And I think one thing is that, the S&P 500 is not an asset. The S&P 500 is the aggregate of 500 firms. And we do know that there are some market inefficiencies in individual firms. And we do know that funds are trying to exploit these. So what would be interesting is to see, okay, the S&P 500, they've fully integrated that it's efficient. How do you get to efficiency? So probably they're right, not trying to figure out mispricing in the S&P 500. But how do we get to efficiency? Well, if we get to efficiency in each individual firms, we'll get to efficiency on the index. And I think that's where you could have a very similar approach, but for individual firms. And for individual firms, we do know that there are some strategies where you can exploit information. And I think that's where it would be really interesting to see in a similar experiment if this time, the professional investors, maybe the MBA students, maybe if we're actually getting them to learn something, would they spot this mispricing? Would they be able to spot things that we know can work? So I went fast, so I'm happy with that. I think it's a really important question. I do think it's a new paradox that is really worth exploring. I really believe that even with information, it's hard to get to a price. So I think this is a really important question to answer. But I would suggest that maybe this new paradox should be done on individual firms. And so to disentangle whether it's mispricing or whether it's because people internalize that you shouldn't try to find mispricing on the index, it would be interesting to use like underreaction, overreaction, price-earning ratio drifts, momentum. We know people use momentum. They use value, like all of these strategies that we know people are exploiting. Can you try to see how well and how quickly people are going to exploit this mispricing? And would they exploit it? And then in a more theory way, will that give us the efficient market hypothesis on the index? Like if people, depending on how quickly people are efficient in exploiting information on individual assets, can he squares away why the index looks very efficient on its own? All right, I'm